Warm greetings from the NMIMS University Students' Council. We, Ayush Tani and Namrata Brito, are your hosts for today. We're delighted to deliver a podcast on the topic of mutual funds, investments, and finance. These are areas of interest for many students and professionals alike. And our guest today is an expert in this field with over 18 years of experience. Presenting to you Mr. Suraj Saraf, VP and Head of Products at PGIM Mutual Fund. His experience spans across companies such as SBI Mutual Fund, L&T Mutual Fund, among others. We're very happy to have you on board with us today, sir.
Thank you.
So to start off the session, could you please elaborate on the importance of time value of money for our students?
Yeah, sure. So that's a very good question to begin the session. So the world of investing is built upon this single concept of time, which is time value of money. So this is based on the basic belief that instead of instant gratification, there is a reward to be had for delayed gratification. So that is the basic premise on which this time value of money concept is built. So what this means is instead of receiving a sum of money today, an investor will prefer to receive the same money of amount of money later on if he is given a interest along with it. So that's the whole concept of delayed gratification. Now the formula, as you all may be knowing, is the future value of that amount of money is equal to the present value multiplied by 1 plus r, which is the rate of interest, raised to the power of n, which is nothing but the time. Now the formula and concept itself is very, very simple, but it has multiple implications in the investing world. Now, firstly, embedded in this is the understanding of inflation and value of currency itself. So let me elaborate, take a hypothetical example of 100 rupees today, which may have a purchasing power, say, for example, it may buy 4 apples today. But will the same 100 rupees, with that, will you be able to buy, say, 4 apples 1 year down the line?
No.
Perhaps not. So that is simplistically the inflation, which is eroding the purchasing power of 100 rupees. So that's in the formula of time value of money. When we compute the R, which is the rate of return we require for delayed gratification, we have to make sure that the R is positively adjusted for inflation. Whatever is the inflation rate in the economy prevailing at that point of time. So this time value of money takes importance because you have to assess what the inflation is in the economy. The second embedded consideration in the formula is the concept of risk. So say for every percentage increase in the R or the rate of return in the formula, there is a tacit understanding in the world of finance and investing that the risk to the capital will also go up commensurately. So if you're want to make additional return, you have to undertake additional risk. That's the rule of thumb. Now risk can be of many forms. For example, say something like credit risk. So perhaps we'll discuss these concepts maybe in detail if we get into some other forum later on. But just keep these broad things in mind. Now, third, along with it, the embedded consideration is the opportunity cost. So when you look at time value of money, you have to also calculate the opportunity cost. So decisions like whether you want to save or invest or spend, all this can be considered or undertaken if you calculate exactly what is the benefit and trade-off that you're getting. For example, you may be willing to invest in a bank FD. But there's also a decision to be made whether if you have taken a loan, whether with the same amount of money, can you want to prepay that loan. Now, all these decisions can be simplified if you calculate the present value of all these two scenarios and calculate what is the risk reward that you are undertaking. So that opportunity loss or opportunity cost that you're foregoing can help you simplify the decision between investing or maybe prepaying a loan. Now, the final point in this is now as a retail investors, there is only one variable in the entire equation, the formula that we talked about, where we tell our mutual fund investors to focus. So our mutual fund investors, so if you look at the formula again, the present value or the monthly saving that our investors are doing depends on their maybe monthly salary. And there is nothing really they can do to increase it beyond a point. So if you're getting a salary, you're saving X percentage of it and investing it. That's the best you can do. You can't do really much to increase that monthly savings rate. Also, the R, the rate of return, is also a trade-off as we spoke, where you look to optimize risk and expected return in future. And beyond a point, we don't advise to take additional risk just to get additional expected returns, because that means it can be volatile also. So the only variable under our control is the N, which is the number of years. So as a mutual fund investor in a mutual fund company, we advise our investor to maximize this variable and maybe focus on this alone, because that variable alone, the number of years you are invested, it can help immensely. And to conclude, as Einstein famously said, compounding is the eighth wonder of the world. What that really will focus on time value of money, the focus on time does is it allows the power of compounding to work in your favor.
Got it. So only thing that we can control is the time. The rate of return depends on the conditions of the market. Capital depends on the salaries that the people get. We only have the N in our hands, right?
Right. Exactly.
Moving on to the next question. How do you stay current on industry trends and the market news?
Yeah, so in this, currently it's an information age. There are a number of ways to get free quality information, and frankly, it's a overload. So sometimes you really struggle to keep up with all the information that you get. So updating yourself, keeping up yourself updated, it's not a challenge anymore. The challenge is to actually filter the information that you're getting, to separate the noise from quality information that you are seeking, and maybe focus there. So for my day-to-day work, for my office work, firstly, specifically for my office work, I rely on various software and tools such as Bloomberg. Then there are specialized mutual fund research tools from ICRA and CRISIL. They have their own mutual fund tools. So those actually help me to stay up to date on whatever is the trends and happenings in the mutual fund industry particularly. Apart from that, overall in the broader investment world, I look at websites like Morningstar, Value Research. For my general reading, I rely on a lot of apps nowadays which actually curate all this information. So something like FinShots, I really love that app. Say Mint newspaper, apps like Fidly. I don't know whether you use that or not. It actually kind of, you can search it through keywords. So if you put mutual funds India as a keyword, you can get the mutual fund news for the days in that app. So it's a subscription-based app, but it really simplifies everything. Something like Money Control to track the markets. And of course, there's this whole WhatsApp university, so I'm part of a lot of groups and all that. Then there are websites internationally like Zero Hedge, etc., which give you some different perspective of, say, geopolitics. That is a big thing to track in investment world nowadays. Say after this Russia-Ukraine war and whatever is happening in different parts of the geography, Indian investors are affected by it. So it makes sense to track whatever is happening globally. So yeah, basically these are the sources I rely to keep myself updated.
That's a lot of sources, because staying updated with all the news is cool, but how do you filter through and make sure that you only see, what is important to you?
Frankly, that's a challenge. It's a very big challenge, and filtering, because of all the extra information that you get. So this use of technology, I think in the last couple of years, ever since the pandemic, I have actually adopted to all this, and using this app-based services where you can filter through keywords, and you can feed in your interest, and they have this algorithm where they show you the whatever you have read in the last couple of days. They'll throw out those results and suggest those readings. I think that has made life a little simpler. So apps like Fidly, etc., I rely on them to actually give me some filtered, curated news.
Got it. Okay. Moving on to the next question. What is your process for vetting which investment products are suitable to you and to be released to the general public?
Yeah, so this is actually a very kind of a complex question. So I'll try to simplify it as much as I can. So I'll just take you through the example in my current organization. I'm with PGIM India Mutual Fund, heading the product desk. So we have 3 different investment management licenses. First, of course, is the mutual fund license, where we have the portfolio management services license, the PMS license. And third, we have the AIF license, which is the alternate investment fund license. Now, the process of vetting, coming to your question of which investment product is suitable, now actually depends on the platform on which we are launching the fund. I'll just give you, actually a very detailed concept, but I'll just give you a very simple example to understand in terms of mutual funds. which is a mass product. Retail investor can make investment as little as rupees 500. On the PMS side, it's actually the ticket size is minimum 50 lakh rupees. And on AIF, the minimum ticket size is rupees 1 crore. So there's a demarcation in terms of investor profile there itself. So you have on the one hand retail investor, then you have a little more sophisticated investor in PMS, and then you have accredited investors or some institutional investor, those kind of investor in AIF. So the level of understanding, etc., maturity in terms of product and that differentiation is actually built on the platform itself. So suppose if we decide to launch a small cap fund, so on the mutual fund platform, we'll offer it to general public, but perhaps the differentiation in the way we'll manage it. We'll manage it a little defensively. We'll try to mitigate risk. We'll try to control the risk as far as possible by diversifying over a larger number of stocks, say 50, 60 stocks in the portfolio. Whereas if we had to launch the same small cap fund on a PMS platform, perhaps we'll be open to take more risk. Maybe we'll create not a very diversified portfolio, but a very concentrated portfolio of say 20, 25 stocks. And the objective will be to maximize return for a given level of risk. Now the same thing, a small cap fund on an AIF platform, for example, there will be able to take even more risk, perhaps invested unlisted stocks also in their pre-IPO stage and try to maximize returns even further. So it all depends on the mandate of the fund and the platform we are launching on.
Got it. So the AIF would be, targeted towards more of the experienced investors who have a lot of capital at disposal. Okay, got it. The next question would be, how do mutual fund companies assess and quantify risk in investment products?
Yes. So mutual fund in India are very highly regulated. There's a government body called SEBI, Security and Exchange Board of India, and they have done a fabulous job over the last 1 or 2 decades of actually regulating the industry. And there are a lot of regulations which they have brought forward, which are not there existing internationally also. So it is that tightly regulated. So now within the mutual fund space, in a mutual fund company like ours, there are typically 2 departments. One is called the compliance department and other is called a risk department. Now I'll tell you, coming to your question, the compliance team is responsible for implementing guidelines as set out by regulatory bodies such as SEBI, RBI, or even government. And they try to keep everything, whatever activities we are taking on the investment side in mutual fund scheme, aligned to all the regulations that are there. So there are no violations, no breaches on a day-to-day basis. This is the team which is responsible. Now, regulators, as I said, over the years have got very stringent, and this actually takes takes care of a lot of risk at upfront. Now, additionally, we also have a risk team, which is partly responsible for assessing risk in all our schemes and portfolios that we manage on an ongoing basis. So just to give you one example, risk team on a daily basis will look at the liquidity factor in a portfolio. So in a equity-oriented portfolio, and how will they go about it? They will look at the average traded volume of a particular stock on the exchange for say last 1 month or so. So by doing this, they will be able to calculate the number of days it will take the fund manager to liquidate the portfolio back to cash if required. So suppose there's some emergency, there's some redemption pressure, you have to raise cash, so you have to sell the stocks in the market and realize the cash. So this kind of ongoing, portfolio stress testing is carried on by risk team, which takes care of all these parameters. Now, this is very important in terms of the small cap fund example I gave you earlier. Now, in small cap, typically in India, it is little illiquid, right? You just can't go and sell a huge quantity without having an impact cost. So this is where all this kind of activities becomes very important. And as I said, if you have redemption pressure or anything else, you are taken care of. So we make sure that we invest in only very liquid names. And that's the kind of rearguard action we have in our portfolios.
Okay, so I guess behind the scenes, the risk teams would be, assessing risks and, going through many complicated formulas. But for the average person, the riskometer does pretty well, right?
Yes, exactly. So riskometer is actually very generic, but it does the job of at least the first level risk assessment.
Okay, got it. Namrata will be taking the session forward.
Yes. So coming to the next question, what do you think are the potential risks and benefits of investing in emerging markets?
Right. So yeah, this is actually again a very complex question. I'll try to simplify it as much as I can. So emerging market is a basket created by say players like MSCI who have this index fund and all that, and they segregate into emerging market basket and developed market basket and all that. But emerging market is not a very homogeneous market. So you have players like India on one hand, then you have China or maybe Brazil or some Southeast Asian countries on the other hand, with each of these country have their own risk reward characteristics. And then you have the whole developed market space where you have market like US on the one hand, where it is very innovative market, tech oriented market. If you look at that market, all these giant tech stocks like Apple, Tesla, and all that dominate. Whereas on the other hand, if you look at the developed market like Eurozone, it is a completely different market. There you don't see all these tech giants and all that. There you see more old age economic company or maybe something like a luxury goods company. So something like Louis Vuitton, or Ferrari or those kind of stocks may be dominating in Eurozone market. So each market is different and it has its own characteristics. But if you have to pinpoint on ask me whether what is the characteristics of an emerging market, firstly it offers you higher growth. So in terms of GDP growth, in terms of overall economic growth, generally they will offer you a higher growth compared to a developed nation. Okay, now that is not that is these are rules of thumb. These are practically, if you analyze the data for say last decade, 2 decades, etc., you will see a lot of anomalies in these theories. Say US have actually outperformed emerging markets in the last decade, pre-COVID also. So just look at it as rules of thumbs, not as practical examples. But yeah, because emerging markets are considered more risky. Now, take example of India. Now, sitting in India, we may not realize because of the home bias that we have, but our country's rating is triple B minus, which is just a notch above the lowest investment grade that you can get, right? So whenever foreigners are investing into India, they obviously take this risk factor into account and they want additional returns to invest in India. The obvious risk because of all this is the currency risk, right? So INR against the dollar has a depreciating trend over the years. Over last whatever decade, if you analyze the data, INR has shown a depreciating trend. So any investor for investing into any foreigner investing into India will look to first hedge this currency risk before taking any positions. Otherwise, he'll have to live with this ongoing currency depreciating trend. So investing in emerging market is really a call on the dollar. You will see whenever dollar weakens, emerging market going up. Whenever dollar strengthens, emerging markets underperforming, so on and so forth. But in my opening statement, when we discussed this time value of money concept, taking that n, the number of years that you spend, I said that is a force multiplier. So similar to that, if you spend long enough time in India, in the last decade, I'll just give you one data point. In India, in the last decade, there have been more than 100 companies which have produced 20% plus CAGR return in USD terms, which is higher than any other country in the world. So if you are willing to stay for longer, say a decade or so, you will make returns in India because of the high growth nature of the market. And it is relatively stable. We all know it's a democracy. There are inherent benefits and all that. So whatever the country rating is controversial, but yeah, India has its own special place in emerging markets.
Thank you, sir. Our last question. What advice would you like to give the students today aspiring to enter the equities industry as a career? Any mistakes they should avoid or be careful of or anything?
Yes. So I'll just give you a lot of generic advice also, apart from specific advice. So first of all, whatever I have learned in my career is to, if you're looking to build a career in, you said equities, I'll modify it to investing. So investing and finance, if you want to build a career, first of all, you have to be a lifelong student. Don't think at any stage, whenever in your career, that you know everything. I am a student still. There are innovations going on in the market and market surprises us all the time. So nobody is an expert. Nobody who's coming on CNBC, all this business channel claiming to expert. Beyond a point, nobody knows anything. Markets are Mr. Market is supreme. So always be a lifelong student. That will be my advice number one. Secondly, equity specifically, since you asked me, avoid trading and gambling and stay clear of things like all this new fad of technical analysis or bitcoins or these cryptocurrencies. I may sound like the somebody's dad lecturing, but that is something which you should completely avoid, specifically since you're still starting your career. I'll not get into reasons of why I'm saying this, but this is my advice to everybody. Thirdly, gain knowledge across all asset classes apart from equity. So even if you're looking to enter into equities market specifically, uh, learn about fixed income market, gold, real estate, alternates, commodities, all these asset classes. Because what will happen is, say, fixed income market, for example, if you analyze fixed income market, if you track GDP, interest rate, inflation, macroeconomics, etc., all this have a bearing on equity market as well. So if tomorrow RBI raises interest rate or US Fed does something in the economy, all that has a bearing on equity markets. So equity market is nothing in isolation. It is all interlinked, and you have to study all the markets even if you want to be a specialist in equity. So that will be my third advice. Fourthly, just a general advice. Don't try to be a specialist very early on in your career. Since you're a student right now, my advice, my personal advice, is to try to be a generalist rather than a very specialist very early on in your career. Maybe later on in your career, you can become a specialist and specialize in some field very specific. And initially, try your hand at all areas of finance and investing. Fifth, I have 2 or 3 more advice to share in terms of general advice. I've learned it the hard way in my career. There was no sessions like this, podcast like this when I started my career. So I'm really glad that you, Namrata, and Ayush have organized all this, and for the benefit of everybody. I'm sure there are a lot of other speakers that you may be interacting with. So my advice, general advice, is to be actually, since you are all inclined towards finance and investing, actually go out and invest and manage your own money. And the approach that you should take is to take the exact textbook approach, the rules of thumb that we discussed, and don't try to be innovative, and don't try to do it for your ego's sake that I outperform the markets, etc. Just be textbook and copybook, and try to apply all those principles of investing into managing your money. However small or that money is, it doesn't really matter. But what this will do is it will give you a perspective of managing your emotions as well, because when you're managing it all, human biases and emotions come into play. Next, embrace technology as far as possible. This I probably need not tell you, right? Because all this generation, you already have very good hang of technology. But finance increasingly is moving towards fintech, and technology is seeping in all these areas. So maybe somebody, if you are so inclined, maybe get into coding and all those areas. It will really help you immensely in finance. And yeah, that's about it. So it's all about, apart from skills and knowledge, it's all about attitude, behavior, and passion. That's what I would say.
Thank you, sir. That was very insightful. I appreciate all the helpful advice you have given us today. Sir, I do believe you have taught us a ton of new information today. We can all learn a lot from your experience. Once again, I thank you for taking the time out of your busy schedule to answer all these questions. We sincerely appreciate the opportunity to chat with you, sir, and we hope that you have also enjoyed this conversation. We thank the NUSC chairperson, Dr. Christine Digima, and the university authorities for their continuing support and encouragement. With that, our session comes to a conclusion. As your host, Ayush and I would like to thank you very much for joining us today, sir. Thank you very much.
Okay, thanks.